Welcome to Markets Now. I'm Michelle Rook with Bryan Doherty with Total Farm Marketing, and we ended lower in the grains on Friday, higher in the livestock futures. And Brian, the pullback in the grains, I know we had some negativity with outside markets and the jobs data to kind of start the day here today, but was it that or was it just some profit taking?
It was both. So in the jobs report, more jobs, worries about inflation. The dollar was up. When the dollar's up as of late, all else being equal, and there wasn't any other news, a higher dollar generally is met with some type of selling in the row crops in particular, and that's been very prevalent this year. But that kind of got washed out by the end of the day. I think it was just, you could call it profit taking, you could call it the idea of trying to buy into strength on a harvest weekend. We're right in the throes of harvest. Whatever you want to call it, it looked like the trade found some selling interest at resistance and followed through late in the session.
Now, the corn market, we had a chart breakout on Thursday and then went up, kind of tested the $5 area, but yeah, we had a higher weekly close. So from a technical standpoint, what do you make of all that?
Yeah, I mean, it ran to resistance today at the $5 mark. But if you look at the chart, we're 3 weeks now removed from when the low was in place. You've got what's called an inverted head and shoulders formation on the chart. And you got this breakout here with a pullback today. It all points to higher. It all looks like about 510, 515 in that area on those technical indicators. So we'll see next week if the market wants to buy into Friday's dip. But as of right now, I'm going to see probably a little bit more harvest results is the more key directional bias.
Yeah. So the corn market seems to me like it's held up really well in the light of a 2.2 billion bushel carryout figure here. So, do you think that we've put the harvest low in already or not?
It's not unusual to see the harvest low come in sometime in the August, September window, usually centered around the supply and demand report. And we had our low in the December corn put in mid-September and right around that report time period. So if the low is in for harvest, it shouldn't be a shocker. The market has a tendency to anticipate ahead of what the actual event is. But I want to be a little cautious because if we find out that farmers basically underestimated, or if the USDA underestimated this crop, we have to leave a little wiggle room for the yield potential to probably hold at last month's or maybe increase a little bit. I would be surprised if that's the case. Farmers go after their better fields first, and we probably hear the better results early on. But it's still early enough that we have to leave that prospect open, that these genetics and good farmers coupled with tillage practices to handle these type of situations may have allowed for a better crop than what we thought just 30 days ago, even 15 days ago.
Yeah. And so that yield will be the main thing you're watching for in the WASD coming up this week.
In particular, soybeans, because that's a more sensitive picture. When you look at the carryout in beans, 220 million bushels, if you add or want to use the quarterly stocks number 244, one bushel, one way or the other, really sets a tone. Either we're terribly tight on U.S. inventory if we're under 50 bushels an acre, or we start moving toward a more comfortable level. And the reason I say more comfortable level, because on the last WASD report, both the world stocks and stocks, the usage numbers are creeping toward multi-year highs. So the world isn't running out of soybeans, but the U.S. could set the tone on the WASD report this month. So far, feedback from farmers, it's really non conclusive. Where it's good, it seems to be really good, and where it's not so good, it's not so good. And there's a lot of farmers that one field will be 65 bushels an acre, the next field's 45 bushels an acre. It's soil profile, timely rains, spotty rains. So the jury's out for sure yet.
Yeah. We have had a big correction though in the soybean market, over $1. And so is it likely that maybe the lows are in or not?
I'm not going to go out on a limb and say that likely they are, because the momentum is still down from when the market peaked. So in the bigger picture, when you look at this, the market peaked at 11.30 in spring, then rallied over $14. Now we set back right about a 50% movement here. So that's why this yield, the taste on yield that the market gets into the next 10 days, 15 days, will likely set the tone. Because if we break this 50% retracement area, and we're right at it, We're also at the neckline of a head and shoulders formation. All of that points downward, potentially down to 1150 or 1130 in that window there. On the other hand, if we find that the later harvested beans just don't measure out, and we start talking about 49 and a half bushels an acre, the same number as a year ago, all of a sudden our carryout narrows in well under 200 million. It's just too tight to expect that prices go lower. So it's really on a pivotal point right now. We really encourage farmers to really think about strategically how they want to handle this potential breakout one way or the other.
Yeah, definitely watching those charts, but it has looked pretty ominous there. Wheat market had an up week here, and do you think that we can build on that?
Well, I think the market can. That's a good up week, 26 cents plus on the Chicago December contract there. You kind of step back, look at big picture. There's some numbers out of Europe that overall grains in Europe down will be reduced due to dry weather. You talk about Australia and their concerns with El Nino, and you look at a low-priced wheat crop in which exporting countries, they have their second lowest supply on hand in history since records were kept in the 60s. And so there's not a lot of excess wheat out there. The corridor opened, not through an agreement, but it opened through confidence. And now it looks like the war is escalating again. So a lot of uncertainty there. Wheat is a lowly priced commodity compared to where it's been. My only caution here is that the fund money has steadfastly stayed short the wheat market. They continue to sell the rallies. And so when we got a bump this week, we really have to see where the money flow is in the next 1 or 2 weeks to argue if the low is in or if this is just a rally waiting to be sold by the fund money again. Fund money, big picture perspective, I think, has viewed itself or views the marketplace as one where Russia has had a lot of wheat. The world hasn't been, quote, starving. You can look at it that way if the war escalates, but there's been wheat available to the market and the rallies haven't held themselves.
Yeah, so true. And there's just not been a catalyst to get those funds out of that short position they have.
Well,
For
especially
sure.
the dollar rising the way it has the last couple of months.
So true. Talking about macroeconomics, obviously the cattle market has been really sensitive to that recently, and we've had the third lower weekly close here. Are we due for a bigger correction, do you think?
Yeah, kind of all got started a couple of weeks ago when the cold storage report had a little bit of an increase from the previous month, and that seemed to set the tone that traders were reluctant at these high prices to believe that we're going to see a sustained push. I think the interesting thing in the cattle market is it has been in recent weeks anticipating that we'd see some economic data that would indicate slowdown. We didn't see that today. And so more people working, in theory, more consumption. Big picture, though, we can't get past this point when you look at the spread between beef and pork prices and that spread differential. When the consumer starts to back away from beef and maybe moves toward pork, maybe it takes some kind of expectation for higher unemployment numbers. Not sure there, but it's been a pretty interesting study to see how the beef market continues to find demand. My thinking is it finds demand. If you go into a restaurant, the portion sizes are lower, so people are still ordering. The portions are just a little bit lower, but the pocketbook is going to speak volumes here. If beef prices can't move higher when the consumer starts to back away in lieu of cheaper substitutes.
Yeah. Do you see that demand is picking up in the pork side of things? Because I know we had a really good week of weekly exports.
Yeah, we did. So the market, I think it's responding to low price. So when you see exports like we did this week, substantially greater than in previous weeks, the market seems to be reacting to demand and perception that you're going to see a continued buying. And I think we saw that too in the corn market as well. To switch gears on you, going back, Mexico is a big buyer. End users are signaling that they're stepping up to the plate. They don't expect a lot of downside in either pork or in the corn market. So we're starting to see those numbers pick up. Corn was more impressive on the exports than soybeans as of late.
Yeah. And the milk market, September was not a good month for milk, and we had a lower weekly close again this week. So, are we going to see more pressure there?
I think we're getting back to market clearing forces prices, and you're entering the season where, in theory, cheese should really start to firm up as the processors look ahead to winter demand, Christmas, Super Bowl, all of that, start picking up supplies that are pretty cheap right now. I think one of the things that happened in the dairy industry is the market got a little bit ahead of itself. It showed strong gains, expecting that consumer demand would hold true. And then all of a sudden, we saw the cheese buyers back away from the market, and it kind of fell on its own here. We didn't really see the bigger herd liquidation numbers that we anticipated. And again, that to me goes back to the function that is a heavily capitalized industry, first of all, so that you expect that the cycles will be longer. But secondly, from earlier in the year, there were good hedging opportunities and there were good insurance purchasing opportunities, and therefore, I think producers stayed longer into the production cycle because they, even though the market was down, they weren't quite beat up as much as you'd think, and then they've become over the years more adept to using the tools to shift risk.
Bryan Doherty with Total Farm Marketing. That is Markets Now.